Welcome to another episode of Investments in Focus. Today we are excited to have Danny Friedman with us from MakeSpace. So Danny's here to talk to us today about the MakeSpace Capital Partners Fund. At the end of the presentation, if you have any questions or if you'd like to learn more, I encourage you to reach out to your private wealth advisor. So with that, Danny, I'll let you kick it off.
Thanks, Darren. Appreciate you having me here. And I was like talking to investors and talking about self-storage. And I'm going to talk specifically about our investment in stabilized storage properties, MakeSpace Capital Partners 1. Obviously, I can't cover everything in this presentation, so do talk to your advisor if you're interested. We have a full offering memorandum that you can read. So I'm just going to talk basically about three things, like why self-storage, like what makes it a good investment as a whole industry, why MakeSpace Capital Partners, and then why is now a good time to invest. And just to give us a sort of highlight of who we are, we're a private storage fund. We've built a portfolio of storage investments. We're currently at 18 storage investments across from Ontario to BC. It's an opportunity to invest in the yield of that portfolio as well as the sale of the portfolio as a group. And again, our yield is 6% annually, paid quarterly. So let's talk about what are the demands of self-storage. So self-storage has been a great investment for the last 30 years. It really hasn't been a bad time to invest in storage, but the question is it going to continue to grow the way it has? And the main driver of self-storage is demand. And obviously in Canada, as we continue to bring like pump immigration, over 400,000 people came into Canada this last year in 2022. We're expecting another 500,000 per year for the next 3 years. And that drives, the need for accommodation. That's driving prices, and that driving prices is creating, people can afford smaller spaces. So, people are living in smaller spaces. They still like their stuff. Everybody likes their skis and their bike and their, the stuff for their grandkids. And those are the main drivers of self-storage, and we expect demand to outstrip supply significantly over the course of the next, foreseeable future. And here you can see just the returns of storage. Actually, I skipped a slide here. What I love about this is, first of all, like I said, it's there really hasn't been a bad time in the last 30 years to buy into self-storage or get involved, but not just in terms of the returns, which are really high, but also in low volatility. It's not only outperformed all other REITs across North America, but also in volatility, it's been the least volatile. And that just speaks to the fact that storage has demands in all markets, whether that's an inflationary market, whether that's a recessionary market, or whether we're sort of just going steady Eddie. Self-storage continues to be in demand. And this chart ended in 2017, and this just to show that even in the pandemic, in 2020, 2021, we're still seeing storage as the number one U.S. property sector in terms of returns. So let's talk about our business model. It's a very simple model, building a portfolio of storage investments. They pay they're stabilized storages, so we're not doing a lot of development in this portfolio. They pay off a 6% yield, and that goes straight to investors. And then at the end, as we grow our portfolio, and we currently have 18 storages, which is one of the strongest portfolios in Canada. And as we sell that as a group, we're expecting to get an improved return, 12 to 15% IRR over the course of that's returned to investors at the end. And, let's just take a look at our business model. So often when you get into self-storage, you'll have some money, you'll buy a piece of land. Typically you'll spend about a year in permits, then you start doing the land, then you start building the building, and then you start leasing up. And this is just the flow of capital going out. Now capital starting to come in. And then when you're about 50 to 60% full, now you're stabilized, right? And you're profitable and you can grow. And this is a great business, self-storage. Now you have years and years of revenues, and you can do little things like control your expenses or appreciate rates as demand increases. And we do this. And if anything, I think in storage, actually, it's a bit of a steeper curve than that. But with MakeSpace, we actually have considerable ancillary revenues that we add to the sites in our portable containers, Purolator, U-Haul, things like that take the lid off of the revenues and the NOI or EBITDA in each of our storages. And I'll show that later in this presentation. how we've been able to grow revenues way past what normal expectations would be for a stabilized storage. So let's take a look at where we are at our portfolio now. So we started in 2019. We had 2 assets, one in Pender Harbor, BC, and one in Winnipeg. We basically said to a group of investors, and we said, we think we can build a portfolio of storages across the country. So we took our equity in those 2 assets and we put it into the fund and invited other investors to come alongside of us. Over the course of the next 3 years, in 2022, we've raised over $39 million, and we now have over 18 storages and over 1 million square feet of storage. In 2020, we bought Prince George. In 2021, we had a lot of irons in the fire that didn't come through until 2022, but we did buy a few properties in Regina. And then 2022, we've had just a massive acquisitions. A portfolio that we bought across the country, from Kitchener to Vancouver Island, Edmonton, Calgary. We have a storage in Innisfail, in Estevan, in Prince Albert, as well as portable fleets in Toronto and Vancouver. So we've seen incredible growth. We now have over $130 million worth of storage. And we see over the course of the next 2 or 3 years, adding only accretive storages. And then we'll concentrate on growing the storages and exiting well. So let's take a look at some of our acquisitions. Again, Port Coquitlam, this is probably the jewel of the portfolio. It's built in 2017. It's a really nice facility in the heart of Port Coquitlam. Port Coquitlam is a fast growing area. And high demand, and quite frankly, there's no industrial or light industrial land that would be typical for a self-storage available. And really, towns and cities, they don't like self-storage. They don't want to build more self-storage. It's a big building, a lot of landscape, and only 1 employee. And they'd prefer something like a Amazon distribution center or a McDonald's or a Wendy's or something that pays more people in their constituency. So even in Vancouver, which is right next door to Port Coquitlam, they've now said they're not going to approve any more self-storages. So we're going to see a lot of demand there, and we're expecting to see demand represent itself in rate appreciation over time. I bought a nice self-storage in Prince Albert. I'll go into our Canada-wide portfolio on the next slide. Innisfail and Estevan. And when we buy places like Prince Albert, Innisfail, and Estevan, well, now we're looking at high return properties. So we're buying it at the right price, so that we're expecting, somewhere between 17 and 22% IRR on those properties. They're a real driver of revenue and profit to the portfolio. So going into the Canada-wide portfolio that we bought in Kitchener, which is the fastest growing town in Ontario, second fastest in Canada, in 2021 and 2022. A high occupancy, 96%, 120,000 square feet, projected IRR of 17%. Mississauga, this is a portable fleet in Mississauga called Go Minis. It's for moving. We've owned this for a few years now, and expecting significant returns. Again, 20% IRR. Edmonton and Calgary. Edmonton is nice self-storage. It's actually half built. We have more infrastructure that we can put in there, but Alberta's seeing a renewed boom. And our property in Edmonton is no exception. Calgary is an RV storage that actually just got rezoned in the summer last year to self-storage and portable storage. And we don't know if we're going to build a self-storage right away. It would need water or electric to be brought into the site, but we can't put down portable containers. And those containers, we put down 30 in the last 3 months, and they've all filled up right away. And then in Vancouver Island, and actually in Vancouver Island, we have 1 stabilized storage. That's a picture of it right there in Ladysmith, which is 100% full. We continue to put portable units down there on site, and they fill up as fast as they get put down. The demand is massive on the island. It's so growing, or growing substantially. But also we have a piece of land that we have a 55-year lease at the Victoria Airport. And that's exciting. We're going to be doing a new development. That's the only development in the fund. And that area is of massive demand. Property there is selling from $1.5 to $2 million an acre. We got a reasonable lease instead, and we're going to be building a self-storage and a new self-storage in the area. So I talked about how we could grow our storages past what you would typically expect. And here's our case study in Prince George. So the fund bought the storage, two storages and a portable fleet and a piece of land for 14,350,000. In the 2 years since we've owned it, maybe 2.5 now, but 2 years since we owned it, we've gone from 14,350,000 to over $20 million in value. Now we did develop 25,000 square feet, which is already at plus 85% occupancy, even though it's only been around for about 4, maybe 5 months now. So that cost about 2.5 million. We got about 70% debt, so we really only put down $700,000, and we were able to grow this from, again, 14 million to over almost 21 million over the course of 2 years. And that's just, it's the growth of the portable fleet. It's managing the full facilities that we're appreciating rates with demand, and then building a new facility on a piece of land that we already own. And we know the market well, so we own 70% of the storage in Prince George right now. I'm going to go into that a little bit further. I'm not going to go through this whole sheet. You'll have a copy of the presentation, so if you want to look into it further. But Pender Harbor, one of the original assets that we bought it for just under $5 million. Bought a portable fleet to add on to it for about 400 grand, so call it 5.3. In 2021, it was appraised at 6.2. If we used this year's NOI or 2022 NOI, it'd be appraised close to $10 million. Winnipeg, this is a current appraisal. We went from 5.25 million to 7.5 million in value over the course of 2 years. You talked about Prince George, and then the rest of the assets are, we've owned within the last year, and we expect to see incredible growth out of the whole portfolio. And like I said, that's our job for the next 3 years, is to grow portable fleets, to grow on-site storage, to manage them well, and to really take the lid off of the NOI, so that when we sell it as a portfolio, the sum is better than the share of its parts, but also they have increased NOI in each one of those parts to drive value. Here's a look at our storages. I mean, I kind of like it. I think that they're very basic, and that's who we are. We're not building the Taj Mahals. We have the one really nice facility in Fremont, but overall, we're not building those beautiful storages, 4-story storages that you can see in the city centers. That's not our company. Those are long-term play. They don't have a lot of revenues off front, and I think they're a good investment, but it's not what we do. We buy these stabilized storages, and we make them hum and grow their value, and then together as a portfolio, the value increases over time. So let's talk about our exit. And our exit is planned for 2025. If that's the wrong time, the fund does have an opportunity for 2 one-year extensions to make sure we're selling at the right time. We have a few different options, and we're starting to explore them now. One is we could sell to a larger storage operator. A good example is Storage Vault, and I'll just skip to the next slide where you can see that Storage Vault bought 2 portfolios, one in 2017, Sentinel Self Storage, one in 2019, that's Real Storage. Both of these implied cap rates were under 5%. We've modeled in our 12 to 15% return a 5.75% cap rate. And actually the storages right now, as you're buying in, are valued as individual assets. So somewhere between 6.25 and 7%. So there's a lot of value for Storage Vault. So why would Storage Vault buy at such a great price? Well, their current market value is implied at about a 3 cap right now. So that's about a 33 times multiple. If they buy at a 5 cap, that's about a 20 times multiple. So immediately when the storage comes into their fund, they're gaining a 13 times multiple on their earnings. It's an incredible deal for them and an incredible deal for the people who built those portfolios, and we hope for our investors as well. Another opportunity is to sell to an institutional investor. There's lots of big money and smart money that wants to get into storage, but they can't buy onesie, twosie storages. Like they can't spend 10 million or 15 million or even $30 million. They got to spend, for them to get into it, they got to spend 150 to $200 million. And we would be the only portfolio for sale like that in Canada. There are a few other players that have more significant portfolios than this, but they're in there for the long haul. Like we know those people. They're at the association meetings, and we've been talking to them for years. They're more likely to be a suitor than they would sell instead of us. Also, U.S. institutions have been looking to come into Canada for the last couple years, but they come in, they look around, and again, it's like onesie twosie storages out there. They just can't make it work. That doesn't fit their mandate. But $150-200 million portfolio that fits their mandate. Another opportunity might be to sell to a larger MakeSpace storage fund, which is something we would explore, or create a public vehicle. And that's probably my least favorite now. It's a little bit more costly, and I'm not sure it will make the most sense for investors. So we'll probably exploring the first three most heavily. So why invest in MakeSpace? Like, what's our advantage? Well, we have over 15 years of storage, and that's not like cumulative. That's like we have my partner Vaughn has almost 20 years in self-storage. I've been in self-storage for about 15 years now. We've got a deep understanding of the storage market. We can source acquisitions from our connections within the market. We have self-storage is an incredible downside, or has been incredible downside protection. It has performed in previous recessions, both in 2008 and 2020. Has been a strong performer, and we think it's going to continue to go that way. And I'm curious, like, we're in these inflationary times, and it's turning recessionary potentially. Like, there's always different demands for storage in each market, and I'm curious what the new demands will be this time. And the last day, your money goes to work right away. The rest of the stuff you can talk to your advisor about. Like I said, you'll get the presentation, and I just appreciate you taking a look at MakeSpace and self-storage. And I think we have a great opportunity and a place to, from my perspective, to park money for the next 3 or 4 years. Thanks for your time.
Awesome. Well, thanks very much for joining us today, Danny. Thank you very much for the presentation. Yeah, I'll just reiterate what I said earlier. If this fund looks like, if this looks like something that you're being interested in, or it would be a great fit for your portfolio, I encourage you to discuss this a little bit closer with your private wealth advisor. Awesome. Thanks, Danny.
Yeah, you bet.